Okay, so ready to dive into something that sounds kind of technical, but is actually super relevant to, well, everyone. Liquidity.
And we're not just talking about Wall Street jargon here. This is about making smart choices with your money. Everyday stuff, planning for the future, even if you're just starting to think about investing.
We figured why not go straight to the source, right? So we're using this awesome Investopedia article, Understanding Liquidity and How to Measure It, because, believe it or not, we all deal with liquidity every single day.
Think about it this way. Your refrigerator suddenly decides to retire. Completely kaput. You need a new one like yesterday. But then you
Oh,
realize,
I've been there. You're stuck with takeout menus because your fridge is now a biohazard zone.
right, and you're scrambling thinking, how do I swing this giant purchase? That's where understanding liquidity comes in.
So, like, cash would be the ultimate, right? Since you can use it for pretty much anything.
Exactly. The king of liquidity. You hit the nail on the head. The Investopedia article even calls it the most liquid asset because you can exchange it for goods and services instantly, no waiting around. But life would be too easy if everything worked like cash, wouldn't it?
For sure. I mean, take that stack of vintage vinyl you've been collecting. Could be valuable, but
Finding the right buyer, someone who actually pay what you think it's worth, that takes time, effort, maybe even a little luck.
totally different ball game. So are we talking about like levels of easy here?
Yeah.
Selling a house versus selling a few shares of stock? Those feel miles apart.
You're spot on. That's the heart of it. It's not just about what you have, but how easily you can turn it into cash when you actually need it. And you're right, there are different types of liquidity. The Investopedia article breaks it down into two main ones: market liquidity and accounting liquidity.
Two sides of the same coin then, but both important to understand. So what's the difference between these two, market liquidity and this accounting liquidity?
Let's imagine you're trying to sell some of that vintage vinyl. Market liquidity is about how quickly and easily you can find a buyer at a price that actually reflects its value today.
So like trying to sell something online on a platform with a zillion buyers versus, I don't know, putting up a flyer in your local coffee shop.
Perfect analogy.
Hmm.
And a key thing in the financial world is something called the bid-ask spread. The Investopedia article explains this really well.
Okay, time for a quick translation for those of us who don't speak fluent finance. What's the bid-ask spread, and why should we care?
It's simpler than it sounds. Imagine you're at that flea market, haggling over the price. The bid is the highest price someone's willing to pay you right now. The ask is the lowest you'll go for it.
So the spread is the difference between those two prices. Got it.
Exactly. And here's what to remember. A narrow bid-ask spread usually means there are lots of buyers and sellers, tons of action. You can buy or sell quickly without messing with the price too much. High market liquidity.
So high demand, prices stay pretty stable. Sounds like a win-win for everyone.
Exactly. But on the flip side, a wide bid-ask spread can be a warning sign. It might mean that thing you're trying to buy or sell, it's not so easy to trade. You might be waiting a while, and you might have to settle on the price to get the deal done.
Okay, so that makes sense for like collectibles and stuff where the market can be kind of unpredictable. But what about something like the stock market? How does this whole bid-ask spread thing work with stocks?
Same idea, just, bigger scale. Think of it like this. Want to buy some shares of a company? Tight bid-ask spread means there's a good amount of trading going on. You can probably buy or sell those shares pretty easily without, causing a huge price swing.
So more players in the game, more liquid the market, easier it is for everyone to get in and out.
Exactly.
Mm.
But here's where it gets a little tricky. We are talking about your hard-earned cash here, right?
Right.
Don't want to just chase after the latest hot stock just because it has a narrow spread. Got to look at the bigger picture.
Right. So there's more to it than just the spread.
100%. The Investopedia article, they actually go into some other important things to look at when you're trying to figure out how liquid a stock is, like trading volume and something called market depth. But actually, before we get into all the ins and outs of the stock market, let's switch gears back to that second type of liquidity we talked about earlier. Remember, accounting liquidity.
Right, right. We covered the whole can you buy and sell it easily thing. Now it's time to talk about the companies themselves, right? So what is accounting liquidity all about?
It's about a company's ability to pay their bills, basically,
Mm.
their short-term debts and obligations. It's how you know if they're financially stable, and it's a big deal if you're thinking about investing.
Because nobody wants to invest in a company that's one bad day away from going bankrupt, right?
Exactly. It's like, can they cover their costs without having to, break the bank? And just like with market liquidity, There are specific ratios that tell us how a company's doing in terms of accounting liquidity.
Okay, so we're going beyond just looking at the surface and actually digging into the numbers a bit. What are some of these ratios? What do they tell us?
Investopedia talks about a couple of important ones. Let's start with the current ratio, probably the most common one. Quick and easy way to see how a company's doing in the short term.
Or break it down for us. How's it work?
Simple. Take a company's current assets, things like cash they have on hand, money people owe them, and inventory, then divide that by their current liabilities. That's their short-term debts, what they owe soon.
So it's like comparing what they have in their pocket right now versus what bills are coming due.
You got it. And usually, a current ratio of 1 or higher is a good sign. It means they've got more assets than liabilities, which means they're in a decent spot to cover their short-term debts.
So, current ratio above, 1 green light. What if it's below 1? Time to panic.
Not always, no. Doesn't automatically mean run for the hills, but it's definitely something to, look into a bit further.
Yeah.
There might be perfectly good reasons for it being a little low, like maybe they're investing a lot in growth right now, or their sales are just a bit down at the moment.
So context is everything, got it. But let's say we want to dig a little deeper. Are there other ratios we should be aware of when it comes to this accounting liquidity?
Good question. That's where the quick ratio comes in. This one's a little stricter. It's like the current ratio, but takes inventory out of the equation.
Interesting. Why throw out the inventory? It's still an asset, isn't it?
It is, but inventory can be tricky. Think about it. Company has warehouses full of stuff that's just sitting there, not selling. Technically, it's valuable, but turning it into cash to pay the bills, that might take a while.
So the quick ratio is a way of saying, if things get tough, how much cash can this company get their hands on without having to wait for stuff to sell?
Nailed it. It's about that immediate ability to pay up.
Okay, so we've got the current ratio, the broad strokes, then the quick ratio, a little more focused on readily available cash. Anything else?
Well, if you really want to know if a company can handle tough times, there's the cash ratio. This one zeroes in on the most liquid assets, just straight up cash equivalents like super short-term investments they can cash out quickly, and marketable securities.
So the cash ratio is like asking, could you pay your bills tomorrow if everything went crazy without having to sell anything or wait for payments?
Exactly. It's that ultimate just-in-case metric.
Okay, I see how knowing these ratios can be super useful for investors. Like getting a sneak peek at a company's financial health before you make a move.
Precisely. But remember, they're just one part of the story.
Right. Got to look at the whole picture, not just one number in isolation. Okay, I want to bring this back to our listeners now. We've talked a lot about companies, but how does this whole liquidity thing apply to everyday people who aren't, professional investors?
Such a good question. Because it's just as important for regular, everyday finances as it is for investing.
All right, walk us through it. How does the average person run into liquidity issues, and how can knowing all this stuff help them make better financial decisions? So we've covered a lot of ground here. Market liquidity, accounting liquidity, bid-ask spreads, all those financial ratios. But for the average person, someone who's not, managing a portfolio for a living, how does this actually play out in our day-to-day lives?
Well, think of it this way. You've got your own personal liquidity ratio, right? Even if you don't have it all calculated out like we do with companies. Remember that refrigerator example from earlier? Imagine if all your savings were locked up in some long-term investment. Something you can't touch without paying a penalty.
Yeah, that new fridge just got a whole lot more stressful.
Right. It's not that you couldn't afford it, but actually getting your hands on the money quickly, well, that's a different story. And that's what a personal liquidity crunch can feel like.
So no matter who you are, it's important to know what you can easily turn into cash without taking a loss.
Exactly. It's all about having choices. So ask yourself, how much do I have that's easy to access? Checking account, savings, maybe a short-term CD, versus things that might take a while to sell. A car, maybe some jewelry, that sort of thing.
It's like taking inventory, but with your finances. And knowing that can totally change how you make decisions day to day. Like, maybe you think twice about that expensive impulse purchase if it means dipping into your emergency fund.
Exactly. It's not about never buying those things. It's about, understanding the trade-offs.
Yeah.
Making sure your overall financial plan makes sense for your goals.
Finding that balance. Enjoying your money today, but also being ready for whatever comes next.
And that brings us right back to why understanding market liquidity is so important when it comes to investing. Because even if a company looks great on paper, if their stock is illiquid, well, you might get stuck. You want to sell your shares, but you can't, at least not without taking a hit.
Ouch. So it's like having a winning lottery ticket, but then you can't find anyone to cash it in.
Perfect way to put it.
Yeah.
And that's where those other things Investopedia talked about come in, like trading volume, how much that stock is actually being bought and sold.
Right. We touched on that earlier, but there was something else too, right? Market depth. What exactly does that mean?
Okay, imagine this. You go to a big, busy market, lots of stalls, tons of stuff for sale, people everywhere buying and selling, prices going up and down. That's a deep market, lots of activity. Then imagine the opposite, a practically empty market, just a few vendors, hardly any customers. That's a shallow market, finding what you want at a price you like. Good luck.
Okay, so I'm seeing the parallel to the stock market. A deep market means there are a lot of buyers and sellers, lots of orders at different price points, which means it's easier to make a trade without, throwing the whole system off balance.
Exactly. It's about having options. And flexibility, which, as we've been saying, is what liquidity is all about.
Options and flexibility music to my ears. Well, this has been a fantastic deep dive, really eye-opening. I think we all have a much better understanding of why liquidity matters, not just in, some abstract financial sense, but in our actual lives.
Couldn't agree more. It's one of those basic ideas that can make a real difference in how we think about money and how we make decisions about it.
So true. As we wrap things up here, what's the one thing you'd want our listeners to take away from all of this?
Simple. Next time you're making a financial decision, any decision, big or small, ask yourself, how does liquidity fit into this? Saving up for something, buying something, maybe even thinking about investing, being aware of liquidity, it just puts you in the driver's seat. It helps you make choices that actually work for you and gives you that, peace of mind.
It's such great advice. It's about understanding the tools we have to build a more secure future for ourselves. Thanks for joining us on this deep dive into liquidity. We'll see you next time.